Good morning, everybody. Happy Tuesday. Welcome back to another edition of the Merkle Market Update. I'm Loren Merkle of Merkle Retirement Planning. Here's where we talk about information that you're hearing about almost everywhere, but we're talking about it in a little different way. Sometimes there's misinformation, sometimes there's further questions that is not easily readily through Google search. And then we're also talking about strategy. How can you take this information and then apply it in a meaningful way to you to help improve your financial condition? This week, we're talking about two main topics. So of course, we have to talk about this economic stimulus. There's about 80 million people that are going to be receiving their stimulus payments this week, which is roughly about half of what is expected to receive these payments. So what do you need to know? What do you not need to know? How can you use this from a strategic standpoint to maybe get the stimulus where otherwise you would not? And then also we're going to talk about this thing that we've been hearing a lot about, which is we can take $100,000, we can take up to $100,000 out of our retirement accounts, not have to pay taxes if we pay back within a 3-year period of time, and wait, we don't even have to pay our 10% penalty that otherwise might apply. So we're going to talk about those two main topics. First of all, the economic stimulus. So you already know you already know probably what it is you would receive: $1,200, $2,400 plus $500 for every dependent child who's 16 years of age or younger. But what happens if you wouldn't qualify for one of the tax years that you should have filed for, but you would qualify for another one? What I mean by that is they're going to go off your most recent tax filing of 2019 or 2018. So if you filed for 2018, but you haven't filed for 2019, should you file for 2019? And a lot of that is going to be dependent upon what your income was 2018 versus 2019. So if you filed in 2018, but you made too much, you're over your income threshold, then it would behoove you to file for 2019 if 2019 your income was under the threshold. Because then if you didn't file, you're not going to receive the economic stimulus payment. Vice versa. Maybe in 2018, you were over the income threshold, you've already filed 18, you've already filed for 2019, you're over the economic threshold as well, the income threshold. But 2020, because whether you lost your job, you got furloughed, your income is going to be lower, you think your income is going to be under the economic threshold for 2020, then this economic stimulus would still be applicable to you. Now, you're not going to get the payment in the form of direct deposit to your bank account, but it's considered a credit off of your 2020 tax filing. So when you file your taxes for the year 2020, you would receive that $1,200, the $2,400, or whatever that payment is you would be eligible to receive in the form of a credit off of the tax payments that you owed for the year 2020. So hopefully that clears up a little bit of confusion, a little bit of information around whether or not you should file from a tax standpoint. But let's talk a little bit about Roth conversions and how that applies to this economic stimulus as well. So what they do is they use from the income threshold, they use your adjusted gross income number. Now, any Roth conversions that you do in 2018, 2019, 2020 go into your adjusted gross income. So there are some people who converted money from a pre-tax account to a Roth account in 2018, which put them over that income threshold, which means they're not going to qualify. They also converted in 2019, which put them over the income threshold, which means they won't qualify for 19. And if you haven't done the conversions yet for 2020, maybe if this economic stimulus payment is important to you in the form of a credit off your 2020 year, tax filing year, maybe you don't want to do a Roth conversion this year. This is important because Roth conversions you can no longer undo, which means you can no longer recharacterize any Roth conversion that's already been done. So once you execute on the Roth conversion strategy, that's a permanent Roth conversion. So take that into consideration with your Roth conversion strategies of this year. Obviously, if you did it 2018, 2019, you can't change it. But if you haven't done it in 2020, then it's something to consider. The other thing is if you have not filed tax taxes for some period of time. And there's about 10 million people that are estimated to have not filed taxes because their income's at a point they're not required to file. The IRS or the system has now developed a new website where you can go put your direct deposit information, or you can file a tax to make it a little bit easier for you to receive this payment. So they call it Get My Payment, and I'm gonna warn you, don't go to getmypayment.com, because if you go to getmypayment.com, you're gonna run into the most affordable and reliable GPS location devices on the market. That's not what you're looking for. So go to irs.gov, that's irs.gov, type in the search bar, it's on the upper right-hand corner, type in Get My Payment. And then there's gonna be a link right below that, you click on that, and then there'll be some instructions to follow. I was out there just this morning right before I came on here, and it says that they're expected to have this developed in mid-April. So it's still not up, but look back this week or maybe even next week, and you'll be able to implement that information to help you receive these payments. Their goal is to get these payments out as quickly as possible. Again, roughly about 50% of us are going to receive these payments within this week. And then if you have your information on file or don't have your information on file, make sure you go out there and make it as easy as possible to receive these payments. This next one, $100,000. This is groundbreaking. This is not something that happens every day. Now, I'm not condoning taking out money from a retirement account, but if you have to, take it out. If you have to, take this money out to use it to continue your lifestyle, to keep the lights on, then take it out, it's yours. There's some strategy around how to do it and then how to repay it so you're not gonna owe a bunch of taxes. And then most importantly of all, you can still continue on your retirement path. So you can take up to $100,000 out of an IRA account that you have, or even an employer-sponsored plan like a 401k plan. Now, it's one thing to know, this is all a part of the CARES Act. So if you have a 401k plan with an employer you're currently working with, so you're currently employed, the employer has to take some additional steps. They have to make some amendments to their plan in order for you to make this eligible. Chances are most employers haven't done this yet. If you're a part of a really big employer, maybe they have been able to incorporate this yet, but give them a little bit of time. Talk to your employer, see if they're planning on making this available, if this is important to you. But the federal law is that 401k plan you're currently employed with, you're eligible as long as the plan provision allows for it. If you're a part of a 401k plan that you're no longer working with the company, or an IRA that's underneath your name, your control, you can take up to $100,000 out. You can take it in increments. So you can take $10,000 this week, $10,000 next week. You can take it along the way. And there's definitely some strategy with that. Remember, this is your retirement money. We all want to retire one day. And if we exhaust this money, and we don't need to exhaust this money prior to retirement, then it will hurt your retirement prospects. So use this as an absolute last go-to, right? That emergency fund you just have to keep the lights on, to keep the kids fed, to keep the mortgage payments going. But you can take it out incrementally. So let's say you have $200,000 in your IRA. We know we can take up to $100,000, but don't take it all out at once. You probably don't need $100,000 this week. If you need $5,000, take it out. If you need $5,000 next week, take it out. And then that way, you're not exhausting that retirement account, because when that money's out, when it's in your checking, when it's in your savings, it's not working for you in a tax-deferred or tax-free nature like it would be in your IRA or your Roth IRA. You can pay it back at any point over the next 3 years at a frequency level of your choosing. And that 3-year time date starts the day after you receive the money. So if you receive the money April 15th, then that payment starts, the time starts April 16th and goes for the next 3 years for each distribution. So if you take $5,000 out April 20th, then you have 3 years from that date. You take another $5,000 out May 20th. You have another 3 years from that date. And this law goes retro. So it goes from distributions that you've made from January 1st of this year, 2020, and it goes for distributions that you may make all the way through 12/31 of this year. So we have some planning, we have some opportunity available. If you're under the age of 59 and a half, Normally, these types of distributions, you would be penalized 10% on whatever that distribution is. So you take the full amount, the maximum amount of $100,000, that's $10,000 that you're going to owe just in the penalty, in addition to the taxes, the federal and the state taxes. So what this law is saying, if you're under 59.5, you don't have to pay the 10% penalty, and you don't have to pay the taxes as long as you pay it back within the next 3-year period of time. Let's say you can't. Let's say you can't pay it back over the next 3 years. Then you have a 3-year period of time that you can spread that tax liability out. So if it's just not in the cards, you take $50,000 out, just not in the cards, you know you're not going to be able to repay it over the next 3 years, then you can at least spread that federal tax liability out over that 3-year period of time as well. This is an important one. This goes to the $100,000 of the 401k distribution. This does not apply to everybody. You have to be directly impacted by the COVID-19. So what does that mean? There are some very specific guidelines, and then there's some guidelines that the IRS has not yet come up with. So I'll just read what these guidelines are. So first of all, you have to be diagnosed with COVID-19 by a test approved by the Centers for Disease Control and Prevention. So you have to have tested positive for COVID-19 by the Center for Disease Control and Prevention. Your spouse or dependent is diagnosed with COVID-19 by the same type of test. You experience adverse financial consequences as a result of being quarantined, furloughed, laid off, or having work hours reduced by COVID-19. You are unable to work because of lack of childcare due to COVID-19 and experience adverse financial consequences. You own or operate a business that has closed or had operating hours reduced due to COVID-19 and has experienced adverse financial consequences as a result. And then finally, you have experienced adverse financial consequences due to COVID-19 related factors, and the IRS is going to have more specific guidelines to come. So the goal is here from the IRS standpoint is you have to be directly impacted by COVID-19. Now there's two ways to think about this. We've all been directly impacted by COVID-19. But what I think what's gonna happen is a couple years down the road, we have some time, the IRS has some time to think about this. They're gonna see that there are some people taking advantage of this type of situation, so they might crack down a little bit harder, and that's why that last bullet point is there. There's guidelines still yet to come. So I would encourage you, unless you were specifically impacted in one of these ways, I would probably not take that distribution out expecting to get that relief, the tax and the penalty relief. If you were impacted by that way, then you can take it out safely and know that you can use this money to further your position right now or just to survive, and you're not going to have to pay that penalty or the taxes. Finally, the takeaways is be careful. Just because we have this ability to take the $100,000 out, make sure you understand the rules. Make sure that the rules are applicable to you and you use them in the best way possible for you as well. Consider your income. So the AGI, as far as the $1,200, $2,400 economic stimulus, make sure you understand all the metrics that go into that. That way you're not planning on receiving a stimulus and maybe it doesn't show up, and then you have to dig further and say, whoops, I did this or I didn't do this the right way to get the stimulus. And then finally, know the rules. There's a lot of red tape that has been eliminated with this, but with the elimination of the red tape, there's some specific guidelines that we have to make sure that we follow in order to not qualify the penalties, not pay the taxes. If we use them to our advantage, then we can take advantage of the extended period of time on some of this stuff. We just have to know what it is that we're doing. So if you have questions on this, you can reach out to us. You're going to find a link on there that allows access of a retirement checkup call direct to me, allows a 15-minute direct access to me. They also have a link to my calendar. It's a direct link to my calendar. If you want a retirement checkup call, click on the link, schedule 15 minutes direct with me. We can have a conversation to see if we can help with whatever situation you are in, and we do that at no cost to you. Stay safe. I hope this helped in some way. Again, if you have questions, follow the link. We look forward to seeing you next time on the Merkle Market Update. Have a great week.